So at what point can an entity start depreciating an asset, and when will an entity stop depreciating an asset? In accordance with IAS 16, an entity will commence or must commence the depreciation of an asset when the asset is ready for its intended use, and not when the entity decides to start using the assets. So let's say that an entity acquires an asset and they have installed the asset. In accordance with IAS 16, all the purchases costs and the directly attributable costs incurred in bringing the asset to the present use must be included in the initial cost of the asset. So an entity buys an asset, installs the asset, and then the asset was ready, everything was done after installation on, say, 1st of April 20X5. But for some reason, the entity decides to start using the asset on 1st of June 20X5. The question is, do we start depreciating the asset on the 1st of April when the asset was ready for use, or when the entity actually started using the asset on 1st of June? The standard states that we start depreciating the asset when the asset is ready for its intended use and not when the entity begins to use the asset. So what does that mean? It means that even when an asset is not in active use by the entity, it still has to be depreciated as far as it is part of the assets of the entity. So what if an entity decides and say that, okay, they are using this asset, but for some reason, they don't want to use the asset for a number of periods. So sort of they decommission the asset. And so if they are decommissioning the asset and the asset is just there, they are not using it for its intended purposes, should it still be depreciated? Yes, it has to be depreciated. Because again, the standard is the asset ready for its intended use? If the asset is ready for its intended use, then failure on the part of the entity not to use the asset is not the responsibility of the accounting standard. But the question we need to ask ourselves is, does that really bring about faithful representation of the financial statement? If the entity does not use the asset, and depreciation is the allocation of the cost of the asset over the economic useful life, then if the entity is not using the asset, we shouldn't depreciate the asset. That is some people's school of thought. But this is what you must understand, that in accordance with the conceptual framework, in accordance with the accounting standards, in accordance with enhancing faithful representation of financial statements, an asset must not be carried above its recoverable amount. So even if we should say that, hey, the entity is not using the asset, for that reason, let's not depreciate the asset, you have to understand that there is a loss in value of the asset, and that could be as a result of time, as a result of usage, as a result of wear and tear. And so it's likely that maybe the entity is not using the asset to generate revenue. However, the asset may have suffered an impairment. And so if we go that route, it still leads us to the end that we have to charge the depreciation on the asset and also test for the impairment on the asset, because an asset cannot be carried above its recoverable amount. Now, this concept is crucial because most of the time we are going to be having questions about IAS 16, and it is always important for us to identify at what point can the entity depreciate the asset. Now, the only point where we stop depreciating the asset will be a number of circumstances. Number one is when the entity decides to transfer the asset from a PPE, property, plant, and equipment, into a non-current asset held for sale. In other words, the entity has decided to sell the asset. The asset is available for sale, so the entity has no intention of using it. The entity has decommissioned the asset. Then the entity is looking for a buyer or has even located a buyer, and the entity expects that the sale will be completed in less than 12 months. And this is the recognition criteria in accordance with IFRS 5, non-current asset held for sale and discontinued operation. And so when the recognition criteria is met, then what is going to happen is that the asset will be derecognized as a as part of the non-current assets, property, plant, and equipment, and recognized as part of current asset, non-current asset held for sale, and discontinued operation. And subsequent to that, the asset will no longer be depreciated, and it will be carried at lower of cost and net realizable value in accordance with how inventories are carried as per IAS 2 inventories. So that is one of the circumstances. Another circumstance is where, again, a property, plant, and equipment is changed into an investment property. And by default, in accordance with IAS 40, investment properties must be carried at fair value. That is the default method. However, where the investment property is of a specialized nature, or the entity cannot reliably estimate the fair value of the investment property in accordance with IFRS 13 fair value measurement, then the investment property may be carried at the cost model, which means the carrying amount of the investment property will be the cost less any accumulated depreciation and or impairment. And so when we change a property, plant, and equipment into an investment property, and that investment property is being carried at fair value, it means from the date of change, that asset will no longer be depreciated if we are going to carry the asset at fair value under IAS 40 investment property. So number one, we are derecognizing the asset and recognizing it as held for sale in accordance with IFRS 5. Number two, we are derecognizing the asset and recognizing it as an investment property to carry it at a fair value in accordance with IAS 40 investment property. That is another circumstance under which we will not be depreciating the asset. Now, one thing you must understand is this. Irrespective of where we are at, it is important we understand that we have to test for impairment for the asset at least once a year. And when we talk about IAS 38 impairment of assets, it is not only a specific asset that is suffering an impairment. Say we have a plant, we have a machine, say we have a vehicle. No, a cash generating unit can also suffer impairment. Now, in a simple language, we say that cash generating unit is simply a group of assets which together can independently generate future economic benefit for an entity. And so an asset can suffer an impairment, a cash generating unit can also suffer impairment. So the department, a segment of a business, the whole branch of a business can be defined or identified as a cash generating unit. Now, how do we test for impairment? We test for impairment by simply comparing the carrying amount of the asset with the recoverable amount of the asset. Now, if you remember, the carrying amount of the asset is simply how much the entity is carrying the asset, or the value at which the entity is carrying the asset in its books at the reporting date or at the date of the impairment testing, right? That is the carrying amount. The recoverable amount, on the other hand, is the higher of value in use and fair value less cost to sell. Now, this is how I want you to think about it. When we say value in use, it is simply the present value of the future cash flows expected to be generated from the continuous use of the asset. In other words, value in use simply means that if we decide to continue to use the asset for its remaining economic useful life, how much are we likely to generate from this asset? And so we're going to be having the annual cash flows coming in from the usage of the asset, as well as if at the end of its economic useful life, there will be a scrap value, then that scrap value will also be part of the value in use. Now, we're going to discount that using the pre-tax cost of capital of the entity. Please take note of that. We would discount that using the pre-tax cost of capital of the entity. And so once we get the value in use, we're going to have that there, the present value of the future estimated cash flows to be generated from the continuous usage of the asset. Then we go to the net realizable value. Think about the net realizable value as the amount to be derived from the disposal of the asset now. So if we don't use the asset for its remaining economic useful life, and we want to sell it today, how much are we going to get? And that is going to always be the fair value of the asset less the cost to sell the asset. And so once we have the value in use, which is the present value of the future estimated cash flows to be generated from the continuous usage of the asset, then we compare that with the net realizable value. The higher of the two becomes the recoverable amount. Where the recoverable amount is less than the carrying amount of the asset, we say that the asset has suffered an impairment, or if it's a cash generating unit group of assets, the whole business, we say that the business has suffered an impairment. Stay with me carefully. If the recoverable amount of the asset or the cash generating unit is greater than the carrying value of the asset, then the asset has not suffered an impairment. The asset will still be carried at its carrying amount. Make sure you get that very well. Where the recoverable amount is greater than the carrying value of the asset or the cash generating unit has not suffered an impairment, and it will still be carried at the carrying value at the reporting date. That is what we must understand about this. But a big question we ask ourselves is this: what if we do the calculation and we realize that, oh, a cash generating unit, that means the whole business has suffered an impairment. In other words, when we compare the carrying value of the business to the recoverable amount of the business, we realize that, the carrying amount exceeds the recoverable amount of the business. It means the business as a whole has suffered an impairment. Now, without thinking too much about it, impairment is an expense, and so definitely we're going to debit profit or loss. In other words, impairment loss will be written off in the statement of profit or loss. Simple. But we have to credit either PPE, or if it's a cash generating unit, we have to allocate that impairment to the various assets of the business. And so the big question we ask ourselves is, how do we allocate impairment of assets to cash generating units? According to the guidelines given by IAS 36, impairment of assets, the first thing we do is to allocate the impairment to separately identified impaired assets. So if in the scenario or in the given question, the asset or some specific assets have suffered an impairment, the amounts at which they have impaired, or the value of impairment recognized in the question, in the scenario, will be charged to them. So that's the first thing we do. If after charging we still have some amount of impairment available, then because it is a cash generating unit, it's a business, if we have goodwill on the face of the statement of financial position, boom, we have to write off the goodwill as well. So that is the second thing we take out. If we still have some amount of impairment left after the separately identified impaired assets and writing of goodwill, then the remaining impairment will be allocated on a pro rata basis on the remaining assets of the entity. Please note that trade receivables, cash, and those other items like trade payables do not suffer an impairment unless otherwise it is stated in the question. So really we would just look at the remaining PPEs, look at the issues in respect of inventories, and then any other assets apart from cash, trade receivables, they will be suffering an impairment. So this is what we must understand generally when we talk about the issue in respect of how we deal with testing of impairment of assets in accordance with IAS 36, impairment of assets. Now, one thing you must understand also is that this whole idea of impairment of assets actually cuts across other areas of the syllabus. If you pay attention carefully, when you are doing consolidated financial statements, at the end of the period, we have to calculate any goodwill on consolidation. And so if, for instance, we realize that the fair value of consideration transferred, which is how much we paid to acquire control in the company, exceeds the carrying amount of the net assets at the date of acquisition, or if you want, the fair value of net assets at the date of acquisition, then the balancing figure is going to be goodwill. Now, goodwill could also suffer an impairment. And so the same principle applies when we are dealing with consolidation. Just so you know, if we pay less than the fair value of the net assets at the date of acquisition, then that will be called negative goodwill. It is called profit or gain on acquisition, and that will be recognized as an income if we are preparing the consolidated statement of profit or loss, or added to the consolidated retained earning if we are preparing the statement or consolidated statement of financial position. So these are the things that we must understand in respect of these various accounting issues. So if you pay attention carefully, you realize that we moved from IAS 16, came to IFRS 5, non-current assets held for sale, then IAS 40, investment property, then IFRS 13, fair value measurement, then the issue in respect of impairment, IAS 36. And you realize that all of these things are interconnected with each other, and that is what I keep on telling you, that the accounting standards are integrated with each other. So when you are studying the accounting standards, you don't just say, oh, I've finished learning this accounting standard. The question you need to ask yourself is, how does this accounting standard relate with other accounting standards, so that when the examiner asks the question and I have to call on 3 or 4 accounting standards to be able to answer the question, I will be able to answer it. If there are any questions you have on IFRS's, the accounting standards, put them in the comment section. I would love to answer them for you in the next episode. Thanks for watching. My name is Nhyira Premium. Remember to download our mobile application, the Nhyira Premium mobile application, on the Google Play Store or the App Store. And also remember to stay connected with us on YouTube and join us on our live lectures. Let me assist you so you prepare well for the examination. Remember, whatever questions you have, put them in the comment section for me. I will love to read your comments and provide you with some answers in the next episode. I'll see you in the next one.